Good afternoon, everybody, and thank you for joining us for the latest in our What They Didn't Teach You at School webinar. This is our series focused on financial planning, on wealth creation, honing in on some of those topics around the things that, as the name suggests, they didn't teach you at school. So the past topics we've covered off on, we've already covered off on cash flow, we've covered off on superannuation, and we've even talked about insurances of the life, TPD, disability sort of style insurances. You can see a recording of those on our website at businessdepot.com.au. Just go onto the blog, and if you filter the blog for financial planning, you'll see a copy of or a link to the past videos. But today we're talking about investment. We're talking about a general discussion around the different types of investments that people consider and some of the strategies, some of the things to take into account when looking at what investment strategy you should put into place. Now, myself as an accountant, I'm often asked about what type of investments people should use or should pursue. But of course, as an accountant, I can't give that advice. Without a financial services license, you can't give advice on what investments people should do. So that's why I've organised the experts to be on the webinar for us today. So joining me today, we have Mitch from our Brisbane financial planning operation. Welcome, Mitch.
Thanks, John.
And of course, Simone from our Sydney financial planning business. Thank you for joining us again, Simone.
Thanks, John.
Now, as always in this situation, when we're talking about anything financial planning related, I do have to emphasize that anything we talk about here today is, of course, general in nature. You should always make sure you seek advice specific to your specific circumstances. Reach out to one of these guys afterwards. I'm sure they'll be happy to have an initial conversation with you. But obviously with the financial services regime, there is a whole process we need to go through to make sure we're looking at your specific circumstances. But let's get into it. Let's talk about investments. And when I think about investments, I go back to the classic sort of risk versus return consideration. How much return are we chasing? What are the risks that we need to take into account in determining whether that return is going to be sufficient enough? No different to when I'm advising a business client about what they're investing in with their business plans. But Mitch, I might start with you to kick us off, if you don't mind. With that risk and return sort of mindset, I suppose, how can we manage our risk when we're making investments?
Great question, John. And I think the answer at a foundation level starts with, first and foremost, having a plan and really understanding what it is you're trying to achieve, be it a short, medium, or long-term goal, and a purpose. What is the purpose of why you're investing? Is it simply to try and get a quick return at a high rate? And there's risks with that. We're seeing that in this market at the moment with people doing certain things we'll talk to shortly. Or is it more about more often what we're seeing with clients is trying to actually get a return on their money through super or through other investments to build up for their retirement, which is a typical goal a lot of people might have. And having enough available to draw down on in retirement is, the big question: how much do I need and how do I get there? And so probably one of the very first things that they didn't teach it at school, or not that I recall anyway, was the concept that people can play with themselves around the rule of 72, a very simple concept around what would it take to double their money. And the idea of using, the figure 72 divided by the interest rate that you're proposing you might return on your investment if you are self-directed. That might give you a figure of, say, for instance, 5% might be 14 years versus dividing 72 by 10. Will give you 7.2 years as a rate of return and how long it will take to double your money. So conceptually, there's many things to talk about, but a very basic level, foundation level, what's the purpose of what you're trying to achieve?
Well, I suppose, and I wanted to direct that question to you first as well, because you also put so many insurances and so forth in place for clients around life and disability, and that's a risk thing as well, isn't it? And as much as anything else, that's a risk of the unforeseen sort of events. And I suppose this investment plan or this investment strategy is probably less dramatic, but it's still just as important to have a plan about what could happen in the future.
Well, it's planning for the great days that you can have, and the last 12 months for a lot of people has been a fantastic rate of return, but they must plan forward for the unexpected, again, that could happen, be it a COVID-related issue or other things that happen in life. So liquidity issues and other things around market volatility and are you going to be happy if the market does go down by 10, 15 or 20%? And how does it make you feel? The feeling of dismay is not one wants to have with how they invest their money. They want to have a longer term plan. And so where some people might want to move money out of the market and not be invested because they're feeling fearful with what's going to happen, others might choose to go into the market and actually use that as an opportunity. And so the conversation that we would have with clients or people should have with themselves is where do they sit on that spectrum of risk and what's their comfort level? And perhaps it's a comfort level they develop over time. And if they're starting out early, they'll develop it. I've had clients in the past in their 70s or 80s, and they've got all these direct shares. You know they've been in the market for a long time because they're very comfortable with how they get paid money and how it works. And that's a time in the market thing.
You mentioned a key word there, didn't you, Mitch? Time. You know, time frames are obviously really, really important for someone's investment plan, for someone's risk. Simone, you got anything to add to that from a managing risk perspective?
Yeah, look, managing risk, there's so many different types of risks, and Mitch has touched on a few. There are a couple of additional ones I probably just like to touch on, and Mitch did allude to that when he was talking about time frame, you know, and when you're a bit younger and you've got more time, particularly when it comes to superannuation, you've got more time to recover. One of the risks that we see, particularly for, say, somebody closer to retirement or entering to retirement, is sequencing risk. And sequencing risk is essentially the risk of the order and the timing of the investment returns won't be favorable to that particular person. And what that means is that if the market went down right before you're going to retire, you might have some issues really recovering because you're already drawing down on that capital. And so that's sort of something that isn't as I guess it's not sort of as much of a concern if unless you start drawing down or you really need that money, if you've got a long horizon. But it definitely is something that we like to raise when, retirement's not too far around the corner.
Well, that's classically the important part of having a financial plan in the first place, isn't it? When are you going to stop accumulating and start accessing your capital from an age perspective?
And when to reassess, it's like, okay, different through your life at different stages, you'll have different tolerance to risk. And it's also thinking about when do you reassess that risk and when do you need to actually draw on funds?
And I guess that's where you guys would be giving people advice as to how to allocate your assets. Mitch, talk to us about asset allocation and I suppose why it's important and maybe even when are those key points that it might need to be changed.
Yeah, for sure. Look, throughout your lifestyle, every 10 years, you'll tend to find that people have different time horizons in their life, whether it's they're starting out with their career, they're having children, they're buying or building a business, or indeed they're getting closer to retirement. And so that time frame and that available cash flow changes as well. With regards to, I guess, how they'd invest money, we often talk to clients about the very simple foundation concept of where does money get placed? And there's really 5 key areas money can go. Cash, and of course, cash at the moment is always king, but cash at the moment is not giving you any return on your investment. So cash at the moment is, the foundation level we all have. From there, we go to fixed interest and bonds. Again, a fairly low base at the moment in how it's developing or how it's providing an investment return. Property, of course, be it through a direct or indeed indirect through managed investments. Australian shares and international shares. They're typically the investment asset classes that we use, and actually coming up with a mix that suits the client is what we spend time doing to make sure that on a good day, they're very happy, and on a bad day being volatility in the market, which we're going to see quite a bit of over the next 5 years and beyond. And that's the market going up and down in value for various reasons. Are they comfortable with that occurring, and what was their reaction? Because the worst reaction people can often have is to get scared and move money out at the wrong time and actually crystallize a loss.
Absolutely. And that really brings in a bit of that human sort of factor, doesn't it? I mean, if I think about sort of my situation, mid-40s, I've got a long way to go before I'm thinking about retirement. So I'm probably willing to take a bit more risk and maybe even invest in a few startups or something or other. Yes. Whereas my old man, he's obviously at the other end, he's retired and he's going to have a much bigger portion of his asset portfolio in cash or interest-bearing returns and direct shares. But it's interesting, the human nature is, because he used to be a business owner, he does like the idea of having a pool of funds that he can invest in other businesses as well. Simone, tell us about that, I suppose, human element, or even that psychology of investing.
Yeah, so psychology of investing, I mean, it spans over, so many different areas. Look, and there's a couple of things that I would talk to around the psychology of investing. One is around behaviors. So when we think about investing, so much of it is actually down to our behaviors and the way that we behave as humans. And that can be, and as Mitch was talking about before, when you come to market returns, we're seeing so many people put more and more money into the market as it's rising, as the prices are going up. But then we're investing more towards the peak, and then as we see the markets drop, we're seeing people sort of pull money out rather than staying in there and riding out the actual the market returns. So I think investing, it's a behavioral thing, and it's up to us and our behaviors individually, and to really understand that. There's actually a really amazing book on the psychology of money by a guy called Morgan Housel, and if you're interested in investing, I recommend picking that one up, because that talks a lot about different biases in investments, and also it talks about people's backgrounds. And I think that's really important, because when you think about your own background, it's a bit about what you've learned from your parents or from your peers or from your career, or really anywhere, and that is applied to the way that you think about money and the way that you invest. So you're investing through that lens of what you've learned. And look, the other thing that I would talk about as far as the psychology of investment goes is, different people with different levels of wealth think about things differently. I was reading a really great article, a really interesting article by a woman called Abigail Disney. And she's actually the granddaughter of Walt Disney. And she was talking about what it means to be part of a wealth dynasty, and the different things that she was taught through that time. And, what a couple of the things that she mentioned, one of them was they will always say to her advisors that were around her, don't spend your capital, invest, spend the earnings, have that passive income. And the other one was, make sure you have your advisors around you as well, tax advisors, investment advisors, and take the advice to help you build that wealth. And it's just interesting to see the different mindsets from someone with a wealth dynasty. And I think that really, is relevant to the psychology behind investing and behind money, because we want to look to people who have that, who have that sort of wealthy mindset as a way to, really apply that to our own lives, so we can invest, even though we might not be part of a wealth dynasty like Disney. We can still apply the concepts.
We're not all that lucky, are we? But it does highlight also the importance of having a financial plan or investing plan that is specific to your circumstances.
Yeah, that's right.
The behaviours will come into play. I mean, Mitch, what do the wealthy do? We've talked about the Disney sort of scenario there. I mean, what else? Is there anything else different that they do, or do they lean upon the barbecue advisor like many others?
Well, I think that's the key thing. They remain educated on the subject matter that they're investing in. Very few wealthy investors that I know or have seen or read about invest in things they haven't researched, understood, and made inquiries before they execute. Now, as financial advisors, we help clients execute a plan suited to their needs. That's what we do. But I'd still put forward to any client that it's important that they also self-educate and understand what it is we're talking about or what it is they're doing. You can't take away self-education. And now Uncle Google can help that a little bit, but also use that sparingly. And I'd also use what your best friend, your mother, your father are doing, and use that sparingly as well, and be informed, but not necessarily follow the herd, because the herd may not be where you want to be. It may not be your comfort level.
But as Simone said, have those trusted people around you that you can lean on for that specific advice. Now, if I go into a topic which is often a little bit controversial, but you talked about the investment options being, effectively your cash, your fixed interest bonds, property, direct shares, or international shares. There's probably one other that's come up a lot more lately, and that's cryptocurrency. I might ask, I don't know, do you want to take this one, Simone? I might ask you first. Tell me about cryptocurrency. Is this a new class of investment that people should be thinking about?
Look, as far as is it a new class? Well, it is a class, and many people are having it as part of their portfolios. So, it is, people are investing in it. The interesting thing about cryptocurrency is we've seen a really, in a very interesting history with Bitcoin. As far as, lots of people have made a lot of money. Some people have lost money. People are going into this sort of craze, as you will, because there's so many different coins available now. What I would say, as far as, is it the next place to investing? A lot of people have made some money, but people have lost money too. So it's a very much beware situation for me. Because when you think about cryptocurrency, it's a currency. People are using it to invest, whereas typically we would use a currency to buy items. But because it's market linked, we're seeing fluctuation. So, but not actual uses yet. All of those, there are many, many uses in the pipeline, and we're seeing some of it, but it's not quite mainstream. My major concern is that there's not an earnings history. So when we look to invest, we're looking for an earnings history. We want to know that where we're putting our money, we're going to get a return from. Whereas cryptocurrency is very much a speculation.
I mean, I assume they make money out of crypto by trading the currency, just like trading other currency. I mean, so you're sort of playing the markets really there, aren't you? Which I assume, Mitch, is no different to trading the stock market if you're buying and selling on a regular basis.
I think you hit the nail on the head, John. It's trading a currency. It's a new form of currency, of course, but I don't know of many clients that are currency traders at the moment. And so I'd put to them, when they're self-directed, it's a self-directed area at the moment. There's not many advisors that I'm aware of that are providing advice on crypto as part of the portfolio. But that being said, I welcome clients that's part of their world. They've done their cash flow. We know that that's the little bit extra they want to do themselves to have a bit of fun. Then that's fine. It's not going to break the bank. But it won't be under advice from an advisor, I propose, certainly through us or most other advisors at this point. And it's just being, again, alert to what you're doing and how the fundamentals of, if you can work out what the fundamentals are of the cryptocurrency are working. And it typically at the moment appears to be more around inflows of money and a capital grab or a capital loss.
I mean, it comes down to risk again, doesn't it? Risk in your particular situation. My concern is that people go into it feeling that they can't lose. There's almost a bit of a greed factor in it. Anyway, we've talked about that enough, but we had to tick that one off because it's something that comes up all the time.
Look, there's probably one thing I just want to quickly add about cryptocurrency, and that is if you're doing it, if you're using it, and you've got yourself like a crypto wallet, and then you've gone from one coin to another, that's a transaction that needs to be recorded for tax. So just make sure that you're keeping your records, because it might just be like, oh, I'm just changing one coin for another, but the ATO views it as a capital gain event. So you just need to keep those records.
And I dare say they don't send us a financial year-end summary of our trades like a stockbroker or something or other might give you.
Yeah. Well, the ones that I've received on the accounting side have been a long list of transactions. So so you need to make sure you've got those ready for your accountant.
Talking about investments and where you invest from, obviously there's personal investments, but one of the big places people invest from is from superannuation. Now, we've already had a webinar to talk about superannuation sort of generally, but Simone, are there different considerations that people should be taking into account if they're investing from their super funds?
Look, I think that when we're talking about investments generally, there's just a few different things that you want to know and understand. And superannuation, like investments outside of superannuation, there are different types of investments that you can go into. So you might have a preference towards really seeing everything that you're invested in. So you might like to invest in, say, direct shares, where you can see the Commonwealth banks and BHP, and you know that they're household names. You can see it go up and down. You know what dividends you're going to get. It's very much in front of you and transparent. The downside of that, I guess, is that you've got that concentrated risk where you might have a pool of money in one specific investment, which might make it that your portfolio is not diversified enough. The other alternative, there's a couple of other alternatives as well. One of them's having managed investments, like a managed fund, and then another one is separately managed accounts, which is something that we're seeing a lot more of these days. managed accounts, managed investments are where you've got a fund manager, you buy units in a managed fund, they manage it for you, and you leave it up to them. You pick a managed fund, or you get your advisor to pick one, and they're the specialists and they go off in a specific area. So they might be, international investments or Australian shares, or they might be diversified. And then you've got, your separately managed accounts where you're investing, and then you've got an investment manager who's essentially managing that portfolio as part of that separately managed account. You're buying into that, and there's a lot more, there's more transparency. You can see your entire portfolio, where everything's at, and there's a bit more flexibility to manage CGT as well. Yeah.
Yeah, I know in my situation, I use my self-managed super fund to do my investing in my shares, because we'll just leave them in there and we'll just see how they go over time. Whereas I have my investment property outside of the super fund, so that I can use that equity in that property for leverage for maybe another property down the path. Would that be a common strategy, Mitch, do you think?
Yeah, look, very common, John. And I think the key thing there is people understanding and remembering that super is just a tax structure. Yeah, it's got some caveats about what you can and can't do, but otherwise it's an investment structure that is there for retirement purposes.
And I suppose those in industry funds and so forth, they do it in a slightly different way, whether they're choosing growth or balanced or whatever. I assume they're still choosing or having some input in their risk appetite and where they want their money invested.
Well, they do, but far too often I see clients that haven't looked at it for years and they don't know how they're invested. And really, they probably need to be up a notch or two versus being down a notch or two. So you're doing yourself an injustice when you ignore what comes through with those statements, or you don't seek advice through your current provider or through a financial advisor, in my opinion. To come back to your first question around, am I seeing property? Am I seeing super being the flavour? Absolutely. I think the key thing there is people having the plan around what it is that they're trying to do over time, understand their cash flow position, the ins and outs of what that's doing, because that will help determine the best strategy that they should undertake.
What about international? I'm hearing a lot of people investing more directly into international shares or international, do you call them ETFs? Is that what you call them?
Yeah, exchange traded funds. Yep, absolutely. Look, Australia represents 2% of the investment opportunities globally. So if you're not looking outside of Australia, you're really missing out on opportunities there. And there are a lot of ETFs that are available. And so ETFs are exchange traded funds. Essentially, most ETFs, or some ETFs just mimic an index. So they might mimic an international index. So you're investing in the entire index. And then some of them actually do a bit more active trading as well. But they are a good way to really get into a diversified portfolio at a low cost. And it's, investing in ETFs has really gained in popularity for that reason.
Now, one of the other asset classes, which we've touched on a little bit, is property. And it is something that Australians seem to love, doesn't it? Now, I've been told that you guys want to ask me some questions about property, given, I suppose, the real estate focus that we have. And so I'm not quite sure about letting go of control of this conversation, but I'm going to hand over to you, Simone. Apparently you've got some questions for myself and Mitch, maybe on property.
I do, that's right. And anyone who knows you, John, knows that you've got a real expertise in accounting and property. And so what we wanted to do is just ask you a few questions about it. And Mitch as well. Mitch has a real interest in property and commercial property too. So, Australians seem to love property, whether it's investing in their home or a separate investment property. Why do you think people love property so much?
I think it's a very emotive thing, and it's a very tangible thing. I think it's as simple as Aussies like to be able to drive past the place and see whether the lawn's been mowed and whether it's been looked after. I think also, obviously, Australia's done very well generally around property, and seeing the capital growth that they get out of property at through different cycles. And so I think they just feel a bit more confident that it's not as risky as putting it in the stock market, where they haven't got any control over what Wesfarmers does or what BHP does, whereas they can apply a little bit of their own personal intel, I suppose. Oh yeah, I think this suburb's going to do well for these reasons. That, and combined with a record of success, I suppose, over time. Mitch, would you add anything to that?
Yeah, I would. I'd say absolutely. it's spot on the money in my opinion. I think the other thing would be, we've never seen a more interesting time with opportunities for people to get into properties, with the way the lending requirements are, with where interest rates sit, with regards to the flexibility in some cases with cash flow. And it really comes down to a controlled leverage approach that a lot of people take to actually get into property. And then, of course, the tax deductibility it may provide some people.
Yeah, and that's a really good point, actually. You know, as far as the tax deductibility goes, is negative gearing still a thing? And can you explain simply what negative gearing is for our listeners?
Yeah, I mean, funnily enough, with the growth in some rents and drops in interest rates in the last little while, a lot of properties which people bought for a negative gearing strategy have actually now turned into a positive gearing, in that they've got to pay tax because they're making money on that property every year. But negative gearing is absolutely still a thing. If we look at the property market and across Australia, generally at the moment, we've had some amazing price increases. One of the funny things and one of the funny impacts of that is a lot of people who had investment properties that they were renting have actually sold their rental properties. So I think we would find, if we looked at the data, that the number of properties available for rent has actually dropped. And so, as anything in any economy, there's always cycles, isn't there? And so we're actually seeing with a lot of our real estate clients that the number of properties under management is actually dropping. Now, what do you think happens when there's a drop in supply? The rents start to go up. So I actually reckon we've got an interesting cycle ahead of us in property, because potentially we're going to have a short supply of rental properties again. And so maybe the investors will come back into the market, and they might be the next push with prices and so forth. But negative gearing, to explain it very simply, is we claim the interest deductions, we claim the depreciation deductions, so that we have a negative income position on that rental property from one year to the next, i.e. we get a tax deduction which offsets the tax we pay in other parts of our tax return. You wouldn't do that unless you somehow paid for that loss every year. And the way you pay for that through a negative gearing strategy is through capital growth. So the essence of negative gearing, get a tax deduction, you get a capital growth on the other side of things, and you're taxed more efficiently, or a lower tax rate for capital gains if you ever sell it down the track anyway. But often the broader negative gearing strategy, get some equity in one property, get the tax benefit, then you might use that equity to go buy another property and keep the negative gearing going while you're building up your opportunity for capital.
And John, if I can chime in there for a second and ask you a question in addition to that, in your experience, what are you seeing with people with the idea of paying down their investment properties over time, holding as a passive asset into the retirement? Is that a common strategy, or is that not something that people do very often?
I'd say absolutely it's a common strategy. But again, it comes back to their specific financial plan, doesn't it? Because if you got all your assets in property at the end and you're at retirement, you can't sell 5% of your property, unless you're selling it to family or something maybe. Yeah. So you get to this point where you might have accumulated all these assets and you need to start accessing your capital. But how do you access the capital? You probably got to sell a whole property, which means you're selling a big chunk of your investment portfolio at big steps. And maybe you sell one and you live off that for a while, then you sell the next one and live off that for a while. But you're going to have this sort of balancing act in between from a timing perspective, I would suggest.
Yeah, that's right. And what about business owners? So are you seeing business owners, investing in properties to run their businesses out of? What do you think about that? Do you think that that's a good strategy, or do you think they're sort of, not on the mark there?
It's definitely a pretty common strategy, and I like it for a number of reasons, but you do have to make sure you look at the business part of the decision and the investment part of the decision. So one of the things I like about it from a business perspective is that if you are the landlord, you're in control of what happens to your property. You can't get kicked out at the end of your lease if you don't want to be. Of course, your property can be resumed or something, but you don't end up with this other layer of what I call landlord risk within your business. If you need to expand, you expand. Yes, you got to spend some money on it and so forth. And so business owners like the control that they get from a business perspective out of owning their business premises. Obviously, the investment has to stack up. And one of the biggest differences between commercial property and residential property is commercial property is less emotional. So residential property will go up based on emotions. It might be a first homeowner surge within the market, or it might be that suburb's got more coffee shops than it used to have, and so more people want to live there, or it's in a particular school zone. Whereas commercial property values tend to go up by the amount of rent that you can recover on that property. So, you know, the yield or the percentage doesn't tend to change a lot, although it's probably gone down a little bit in recent times. But ultimately, the driver of the value of your commercial property is the rent that you can receive on it. So if you are a business owner and you are buying a commercial property and you are the tenant, obviously you need to apply some other market insights, I suppose, to make sure that that remains market value and whether there is this opportunity of capital growth down the track.
Yeah, that's it.
Does that answer your question, Simone?
Absolutely, it does. And the other, you know, one of the other things that I see a little bit with the risk in commercial versus residential is that having a tenant. So there's a lot of, you know, we're seeing a lot of, you know, it's easy to find a residential tenant, but what about commercial? I mean, what happens there?
Commercial tends to have more highs and more, or bigger highs and bigger lows.
Yeah.
Like if you look at the market at the moment, industrial property and warehouses and so forth is just going gangbusters.
Yeah.
Whereas offices, probably not so good in the last little while. You know, everyone's turning into flexi working, work from home and so forth. So many offices are getting rid of entire floors and changing the way they use that space. And so that creates bigger sort of changes within the market. And I think that's a big risk, which is economically driven and out of your control if you're investing in commercial property that you're not the tenant of. Of course, there's also other risks. Okay, so let's say you lose your tenant. How are you going to get another tenant back in there? It's a whole new ball game getting a tenant into a commercial property than it is getting a tenant into your residential property. If you lose your tenant and everyone else is offering lease incentives, then, you know, maybe they're offering 30% of the value of the lease over the lifetime of the lease by way of fit out contribution, by way of reduced rents or something like that. And that is a much more business-like decision, but you have to fund it. And so again, I'd say the big thing is that the big shifts and the big changes from one day to the next with commercial property.
Yeah, and what about some of the other risks? I think that, you know, Mitch, you were talking about some investment risks earlier. Do you have any views on what some of the property risks are?
From a risk point of view, I mean, obviously tenancy risk is one of the biggest ones. How long can you hold that for? In this market, obviously it's not so bad because the interest rates are so low. But really the risk, I actually want to concentrate on the return. If I can give you an example of the benefit behind perhaps buy a commercial property just for a second. And that is, in my experience, a lot of people buy commercial property for the rental yield that it provides, whether it be through their self-managed super fund or whether it be if they're an investor. And obviously over time, they have a fixed contract that might go on for many, many years, unlike a 1 or 2 year, or typically a 1 year rental lease with a residential property. You might have a 5, 10 or 15 or 20 year lease with a particular business. So that's a benefit. But really some of the plays I'm seeing in recent times have been people buying undervalued properties if they're out there, but certainly paying a premium for perhaps an underwhelming property and actually spending some money and time on either increasing its foot space, increasing its rentable or its net lettable area. And actually often what happens then is banks will then revalue those properties based on the net lettable area that it's got available. And obviously with a good solid tenant in there or tenants, if the property allows it, provides potentially capital growth that you can actually build yourself over time. Now, I preface that with do your own homework, because obviously that doesn't happen with every property, but there are different options with commercial versus residential. And I think the interesting thing that John spoke about before that was, I think we're all turned off to at the moment, is there is no immigration to Australia at the moment. So when that actually turns back on in the coming months or years, it'd be very interesting to see what happens to the property market with how that actually reacts and what it's going to do.
Excellent.
Is that all the interrogation, Simone?
Oh, look, I could probably go on for a bit longer, but I think we've covered off on everything I wanted to cover off on today. Just with your experience and interest in property, and you've got a lot to add to this discussion. So I think that the only other thing that I was going to ask about is, do you think that people should get quantity surveyor reports? Promise, that's my last question.
Yeah, absolutely. And from a tax accountant perspective, quantity surveyor reports are a nice, neat, reliable way that we can rely on to get that extra deduction within your rental property, especially if you've got a negative geared property. Some of the older properties it's not as useful for, but if it's a really old property, that the depreciation essentially isn't very high. But as a way to get an extra tax deduction for you, you do need to be aware that because you're claiming a tax deduction for it, there is an impact when you ultimately go and sell the property. Sort of down the track, but generally it's something we would advocate.
Yeah.
Very good. That wasn't too hard, Simone.
No.
Guys, thank you so much for your time today. We just wanted to touch on that overall sort of investment discussion, and obviously one of my key takeaway is, like we talk in business, like we talk with your general financial position, have a plan customized to your specific circumstances. That, of course, links back to our disclaimer, of course, which everything we've talked about today is general in nature, and make sure you have a chat to your financial advisor to get advice specific to your circumstances. Simone, any parting words or tips for people out there?
Oh, look, when it comes to investment, compounding is your friend. Compounding interest is your friend. The earlier you can invest and the longer you can stay in there, the better, because once you have that base, the investment will compound over time.
Especially in the superannuation environment where you've got a low tax sort of situation.
100%.
Mitch, final words?
Very boring, but it's very necessary, is do yourself a personal budget, know what you spend money on, and that will give you a world of opportunity to actually think about what you can invest in once you know what you spend money on, what your obligations are, and what you're left over to invest. Do that first.
And of course, that could link back to our very first webinar we did on cash flow and budgeting. And there's a blog on our website at businessdepot.com.au with a few budgeting tools and tips in there for you. Guys, thank you very much for your time again today. Of course, we're always happy to take any questions. Feel free to reach out direct to Mitch and Simone or myself, and I'll direct your inquiry to the appropriate person. Otherwise, check out the website, businessdepot.com.au, stack of blogs and content, video recordings and so forth on there for anyone that's starting to think about this. Next up in our What They Didn't Teach You at School webinar series is we're going to talk about estate planning. So we're going to get one of our estate planning lawyers on the discussion. I think we've also got Megan Kelly from our financial planning and superannuation team on there, talk about estate planning, some of those key considerations. Thanks very much, guys.
Thanks, John. Bye.
There you go.